Hi, everyone. Professor Sackett-Taylor here with the third installation in this series of video lectures on Chapter 9 from Principles of Microeconomics. We're looking at the decisions of a firm in a perfectly competitive industry. The first part of this lecture series really focused on defining a competitive market and signaling to the producer what the rule should be to follow in order to maximize profits. In the second installation of this video series, we looked at the long run versus short run decisions of the firm involving temporary shutdown versus long run exit. And one thing I was thinking about was that I didn't really love the way that the last slides treated the calculation of total profit using the graph. And I remembered that I have these older slides from a different textbook, but that I think do a little bit better breaking down this concept and visually showing it. So I've switched slides to for this third part. You'll see that they feel a little bit different. Okay, so what I want to do is I want to walk through this practice problem of calculating a firm's profit using the graph, because you will be asked to do this in the homework for this chapter. So we're going to use areas in the graph. The first thing we want to do is we want to recognize that the first decision the firm has to make is the output decision. What is the amount of stuff, the output that I'm going to produce that's going to yield maximized profits? That is the highest profit I can possibly make. And we know that there's a rule associated with this. We want to produce up until a point where marginal revenue equals marginal cost. That's the break-even point on the very last unit. Marginal revenue is how much money comes in from the sale of that last unit, and marginal cost is how much money goes out. So if marginal revenue equals marginal cost, you've broken even on that unit, and you can be sure that any additional output that you would produce would incur a loss. So in a graph, first of all, because we are in a perfectly competitive market, we know that marginal revenue, the amount of money that you bring in, has to be equal for each unit, has to be equal to the price that you sell it for, because we're price takers in this market. I'm going to be selling my product that is very similar to all my competitors' products at exactly the same price that they are. So in this way, we can think of the price as being equal to marginal revenue. And that's where this red horizontal line comes in. It says it doesn't matter whether you're at the first unit of production or the 50th unit of production, marginal revenue is constant. It's always equal to the price that we can sell our product for. So here's an example where the sales price is $10. And so we put our horizontal marginal revenue curve at $10, and we look for the place where it intersects with the marginal cost curve. Where these two curves intersect, the quantity is the same. And so this is the quantity that we're looking for. This would tell us that producing 50 units of output would be profit maximizing. Now I need to address whether I'm covering all of my costs. And here, because the price line is above average total cost, it means that I'm going to be bringing in enough money, in fact, more money than I need to cover both my fixed and variable costs of producing those units. And so here I should expect a positive profit. Now that profit is going to be calculated first per unit. So we're looking at the fact that from the average total cost curve, when I am producing 50 units of output, I can go over to the y-axis here and see that that corresponds with a cost of $6. So on average, when I'm making 50 units of output, it costs me $6 to produce each unit. And I can sell each unit for $10. So the per unit profit is $10 that I bring in minus the $6 that went out. In other words, $4. Now that's the per unit profit. So what I have to do now is I have to multiply that per unit profit by the quantity of output that I've made, which is 50. So $4 of profit per unit times 50 units yields total profit of $200. Now you'll notice that that first part of the equation, price minus average total cost, that was the height of this rectangle. And the second part of this equation, the quantity, 50, that's the width of this rectangle. And so since I'm doing that first height times width, then the total profit is going to be equal to the area of this rectangle, width times height, or height times width, right? All of the area shaded in pink. So now let's look at a situation where they're not making positive profits, they're making losses. So here they can sell their product for $3. They know that that's their marginal revenue. So they draw their horizontal marginal revenue curve and look for the place where it intersects marginal cost. This happens at a quantity of 30. So it's optimal to produce 30 units of output. However, when I'm making 30 units of output, I notice that my price, $3, is below my average total cost curve. So that means that it costs me more on average to make each unit than what I actually get in revenue from each unit. So this is a loss. We're going to calculate it the same way. You first look at the height of that rectangle as the per unit loss. On every unit, it cost me $5 to make it, but I only earn $3 when I sell it. That's a loss of $2. And then I multiply that per unit loss by the number of units that I'm selling. So I'm selling 30 units at a loss of $2 each. That's the area of this pink rectangle, or it's a total loss of $60. I hope that that kind of made it a little bit more clear where that random rectangle in the last graph came from. I like those slides a little bit better. So now we can pick up with market supply in the long run. So remember, we're going to make some assumptions here. We're assuming that all the existing firms and potential entrants have identical costs. We're also going to assume that each firm's costs are fixed. They do not change as other firms enter or exit the market. And we're going to assume that the number of firms in the market is fixed in the short run, but variable in the long run, meaning in the next business cycle, no one's coming in and out of this industry. But over the next year or 2 years, people are free to move in and out of this industry. All right, so we've already looked at this in the last set of slides, but let's review. The short run market supply curve tells us that as long as you can, in the short run, as long as you can cover your variable costs, meaning the sales price is above average variable cost, then each firm should produce its profit maximizing quantity where marginal revenue equals marginal costs. At each price, the market quantity supplied is going to be the sum of all the individuals supplying in that market. So if we've been looking at the graphs of one firm, in a market, if we had 1,000 identical firms, then at each price, that market quantity is 1,000 times the individual. So we're going to see that the curves look very similar, but the scale is different, right? As we build it, we take our points, and this is what builds our upward sloping market supply curve. Okay, so in the long run, the number of firms can change. There's new firms that can enter the industry and firms in the industry that say, I'm done and I need to leave. So entry and exit. What drives entry and exit is how well off the people in the market are doing. So if existing firms are earning positive economic profits, then new firms will want to enter. What this does, remember, one of the supply curve shifters, way back when we started talking about this a couple of weeks ago, right? One of the supply curve shifters is the number of sellers, right? And then when there's more sellers, the supply curve shifts to the right. When there's fewer sellers, the supply curve shifts to the left. So what we're going to see here is that when there's positive economic profit being earned by the people in the existing market, other firms will enter. That increases the overall number of sellers and shifts the supply curve to the right. When you shift that supply curve to the right, as we can see in a graph, the price falls. The price falls, that you can sell your product for, the more people that are selling the product. In essence, the industry gets more competitive. So you're going to earn less profit on every unit. And as profits begin to diminish with each additional entry, entry will begin to slow, meaning fewer and fewer people will want to enter because they're not as lured by those big profits. The opposite is also true. So if the existing firms are incurring losses, some of them will exit, right? They'll have to not just shut down in the short run, but completely leave the industry. This will reduce the number of sellers, shifting the supply curve to the left. And when that happens, prices go up. So as people leave the industry, the people who remain start to earn a higher sales price and therefore larger and larger profits. But remember, they weren't positive profits to begin with. They were negative profits, which we call losses. So as your profits get larger, or as it's really as your losses get smaller, right? So you're like going from being in the negative and you're moving towards zero. So this is what brings us to the zero profit condition. In the long run, through this process of entry and exit, the firms that remain in the industry in the long run will earn zero economic profit because positive profits, existing positive profits, drive entry, which drives prices down, which drives profit towards zero. Incurring losses right now, people will exit, which drives prices up, and those losses disappear. Zero economic profit occurs at the point where the price that you can sell your product for exactly covers your costs. It's equal to average total cost. Since the firms will always produce where marginal revenue is equal to marginal cost, and we know that price is exactly what marginal revenue is in a competitive market, then we're looking for the zero profit condition to occur at the point of a triple intersection: price, marginal cost, and average total cost. So when we look at the graph, okay, before we look at the graph, you might be also saying like, whoa, that's a lot. And why would a business keep operating if their profit was zero? We have to remember here what we talked about in the cost chapter. Economic profit and accounting profit are not the same thing, right? Accounting profit accounts for only explicit costs, things that like are recorded in a bank statement and you can actually track. Whereas economic profit also takes into account implicit costs, the opportunity cost, what your next best option is. So when economic profit is zero, firms are earning enough revenue to cover their cost, and accounting profit is positive. The question is whether when economic profit is zero, what it simply means is the accounting profit that you're earning is exactly equal to your opportunity cost. In other words, what you're doing right now, the profit you're making in this current industry is as good as you're going to make in whatever else you were going to do instead, right? So that's the zero profit condition. It's what keeps people in an industry in the long run, because if they were to leave the industry, they wouldn't do better and they wouldn't do worse. It's exactly the same. That's the zero profit condition. So in the long run, let's see here, we have a horizontal long run supply curve. I actually don't care about this so much. This is where I want to be. Sorry about that. I clicked one too many times. Okay, so on the left is a graph that should look familiar to you now. We've got this upward sloping marginal cost. And actually what they're cutting off is that check shape. It's really like a check, right? They've cut off the piece where marginal costs go down at first. But okay, so this is the upward sloping marginal cost curve. They're doing this because to the left here, people would shut down. So this is really what is being supplied. And here is our average total cost curve. We know that the zero profit condition happens where they intersect. So now on the right, so on the left is a cost function graph. On the right is a supply and demand graph. So we've got output quantity on the x-axis, sales price on the y-axis. Whereas on the left, this graph, this P for price over here, I don't like that they both name them both P. That's stupid. But this is a different P. This is a cost price. What is the price of producing this? This, I guess you could just say they're both dollars. This is the price you sell it for. Okay, so here we are in equilibrium at point A where supply equals demand. And we have an increase in demand for the product. This raises the price of the product. By raising the price of the product, these people are now making positive profits, which is going to force people, or not force, but just going to incentivize people to enter into this industry, which increases the number of sellers and shifts the supply curve to the right and drives the price back down, right? So what this is showing you is that there's a series of steps, but at the end, they always end up back at that zero profit condition. If people start to make positive profits, new firms will enter, driving prices down. If people are making losses, firms will exit, driving prices up. But over time, we always tend towards this zero economic profit condition. Okay. You know, I think that I'm just going to jump to a conclusion here. And this kind of brings together all the different moving pieces that we've learned in chapter 8 as a whole. So first thing, profit maximization. There's a rule, you just follow it. If you want to maximize profit, you should choose an output quantity where your marginal revenue equals your marginal cost. It's the point at which you're going to break even on the very last unit that you produced. In perfect competition, our marginal revenue, the money we bring in, is equal to the equilibrium price. We are price takers. We're going to sell our product at the exact same price as all of our competitors because we're all selling an essentially identical product, right? So this makes marginal revenue constant and equal to price. So in the competitive equilibrium, we know, therefore, if the first two equations are both true, the third equation must also be true. Price is equal to marginal cost. This is that zero profit condition. So the price is the price of that, which is the value to the buyer of the marginal unit. So in a competitive equilibrium, we're maximizing total surplus. And what we're going to see in the next chapter is we're going to look at a different market setting, monopoly, where there's just one seller. There's going to be different output decisions, different profit maximization rules, and different pricing decisions overall. And what we're going to find is that in a monopoly market, we don't maximize total surplus. There's going to be a deadweight loss, and therefore it requires government regulation to promote the equilibrium in the long run. That's a preview of where we're going next. So I hope these slides were helpful. That wraps up chapter 8 for us. Remember, you can always go back and revisit videos, pause and rewind as you see fit, so you can take really good notes. And I'll see you next time.